In the conventional physics of personal finance, generosity is a subtraction event. When you donate $1, that dollar leaves your balance sheet. It is a transfer of wealth from the private individual to the public good, a transaction defined by loss in exchange for moral currency. But in the rarefied atmosphere of the ultra-wealthy, specifically within the top 0.01% tax bracket, the laws of economic physics operate in reverse. Here, generosity is not an expense. It is a sophisticated acquisition strategy. We are looking at a paradox that defies the logic of the salaried class, a scenario where giving away a tangible asset generates a higher net return than selling it on the open market. This is the only sector of the economy where a loss on paper can be transmuted into a gain in liquid capital. Consider a canvas splashed with oil paint. To the uninitiated, it is culture, emotion, or perhaps a status symbol. To the sophisticated tax strategist, it is none of those things. It is a floating variable of value, a portable tax shield, and arguably the most unregulated financial instrument in the global economy. Why does a painting bought for $1 million legally become a $10 million deduction without a single dollar changing hands? How does the simple act of hanging a masterpiece on a museum wall effectively erase millions in tax liability from other income sources? This is not about altruism. While the plaque on the museum wall speaks of philanthropy, the ledger in the family office speaks of wealth preservation. We are not looking at charity. We are looking at the weaponization of the tax code through aesthetic assets. This is the architecture of the art deduction, a mechanism where you don't get rich despite giving your wealth away. You get rich because you gave it away. To understand this machine, we must open the black box known as fair market value, or FMV. In the world of stocks, bonds, or real estate, value is determined by rigid market data. If you want to know the price of a share of Apple, the market gives you a number down to the cent. It is objective, it is inescapable. Art, however, resides in a gray zone of subjective valuation. It is an asset class with no intrinsic yield. It produces no dividends, no rent, no interest. Its value is entirely theoretical until the moment of a transaction. And this theoretical nature is precisely the loophole. The core mechanism at play here is the divergence between cost basis, what you paid for the asset, and fair market value, what an appraiser says it is worth today. For the average taxpayer, this gap is meaningless until a sale occurs, triggering a taxable event. For the billionaire strategist, this gap is a reservoir of potential tax savings waiting to be tapped.
The red laser
Think of the
wall
art market not as a gallery, but as a derivative market for tax credits. The painting is merely the physical vessel for the credit. When a high net worth individual utilizes a strategy involving the donation of appreciated tangible personal property, they are engaging in a form of financial alchemy. They are taking unrealized gains, wealth that exists only in theory, and converting it into a very real reduction in their adjusted gross income. The mechanism relies on a specific provision in the tax code that treats art differently than other capital assets. If you hold the artwork for more than 1 year, it shifts from being ordinary income property to long-term capital gain property. This classification is the key. It unlocks the ability to deduct the full fair market value, not just the initial cost. This is the step up in value, and it is the engine that drives the entire philanthropic industrial complex.
Rhythmic force of its movement.
Let us dismantle this machinery into its component parts. The process operates on a 3-step timeline: acquisition, transformation, and disposition. Step 1.
What began as
The
a simple
input,
wager soon evolved into
strategic
something far
acquisition,
more complex,
and the Freeport.
obscuring the true origin
The cycle
of the funds.
begins with the purchase. However, the sophisticated collector rarely hangs the art in their living room immediately. In fact, the art may never enter the country of the buyer's residence. Instead, it moves directly into the Freeport system. Freeports are high-security, climate-controlled storage facilities located in tax-neutral zones like Geneva, Singapore, or Delaware. These are legal limbos. When art is purchased and shipped directly to a Freeport, it technically hasn't entered the jurisdiction where sales tax or use tax would apply. Here, the art sits. It enters a period of dormancy, often referred to as the seasoning period. Under current tax regulations, the asset must be held for more than 1 year to qualify for long-term capital gains treatment. If the asset is donated before this 12-month threshold, the deduction is limited strictly to the cost basis, the original
Encased
purchase
within the timber,
price.
the
This
artifact
renders the
emits a
strategy
rhythmic
useless.
pulse, defying
So the capital
conventional
sits in the
physics.
dark, maturing. During this time, the art market, driven by manipulated scarcity and strategic auctions, continues to inflate. The investor is essentially parking capital in a vehicle that is immune to inflation and invisible to the immediate tax radar. Step 2. The transformation, the appraisal game. Once the holding period is satisfied, we enter the most critical phase, the appraisal. This is where the transformation occurs. Unlike a stock portfolio where the gains are mathematically undeniable, art appraisal is an opinion. The taxpayer hires a qualified appraiser to determine the fair market value. This is where the inherent conflict of interest in the art world becomes a feature, not a bug. The appraiser knows the purpose of the valuation is a charitable contribution. While they are legally bound to accuracy, the range of defensible values for a unique piece of contemporary art is vast. A painting might be worth $8 million at a fire sale, but $12 million at a high-profile evening auction in New York. The strategist naturally aims for the upper ceiling of this defensible range. They utilize comparables, sales of similar works by the same artist, to justify a higher valuation. If a similar work sold for a record price last month, that outlier becomes the new benchmark for the portfolio. This is the step up in action. The asset, purchased perhaps for $2 million, is now paper valued at $10 million. That $8 million difference is pure manufactured equity. It is wealth created out of thin air, validated by a signature on an appraisal document. Step 3. The output. The execution of Form 8283. The final step is the donation itself. The donor transfers the title of the artwork to a qualifying nonprofit organization, typically a museum or a university. This triggers the filing of IRS Form 8283, non-cash charitable contributions. Crucially, the donation must meet the related use rule. The charity must actually use the art for its exempt purpose, displaying it to the public or using it for education. If the charity simply sells it, the deduction is slashed back down to the cost basis. So the transaction is structured carefully. The museum gets the painting. The donor gets a letter of acknowledgement. At this moment, the trap snaps shut on the tax collector. The donor claims a deduction equal to the full $10 million appraised value against their adjusted gross income. This deduction can generally offset up to 30% of the donor's AGI for the year. If the deduction is too large to use in 1 year, it can be carried forward for 5 subsequent tax years. The income represented by the painting's appreciation, the $8 million in growth, vanishes. It is never taxed. The capital gains tax liability is effectively zeroed out, while the ordinary income tax liability is drastically reduced. To see the true magnitude of this mechanism, we must run a comparative simulation. We will analyze two parallel universes involving the same asset and the same high net worth individual. Let's assume a wealthy investor in the 37% federal income tax bracket, subject to an additional 3.8% net investment income tax and perhaps a 13.3% state tax, effectively handing over half their income to the state. Scenario A, the sale. The investor bought a Basquiat for $2 million years ago. It is now worth $12 million. They decide to sell it to realize the profit. The sale price is $12 million. The profit is $10 million.
The IRS treats art as a collectible, taxing the long-term capital gain at a maximum rate of 28%, not the favorable 20% rate for stocks. Add the 3.8% net investment income tax. State taxes apply. By the time the dust settles, the investor might pay upwards of $3.5 million to $4 million in taxes on that sale. They are left with roughly $8 million in liquidity. Scenario B, the strategic donation. The investor donates the same $12 million Basquiat to the Museum of Modern Art. First, they pay $0 in capital gains tax. The $10 million in appreciation is completely ignored by the IRS. That potential $3.5 million tax bill evaporates. Second, they receive a charitable contribution deduction of $12 million. Assuming they have sufficient income to utilize the deduction, this $12 million write-down shields $12 million of other ordinary income, salary, business profits, dividends, from taxation. At a blended tax rate of roughly 50%, a $12 million deduction puts $6 million of actual cash savings back into their pocket, cash they would have otherwise paid to the government. In the sales scenario, they net roughly $8 million. In the donation scenario, the math gets complex. They lose the asset, yes, but they also avoid the transaction costs of selling. Auction house premiums often run 10 to 20%, slicing another $1.2 million off the top.
This is how the network visualizes
But here's the kicker. The donation buys social capital. It buys a seat on the board. It buys the family name on a wing of the museum. And in the world of the ultra-wealthy, social capital is a leverageable asset that leads to deal flow, private equity allocations, and elite networking. When you factor in the tax savings of $6 million, plus the avoided capital gains tax, plus the avoided auction fees, the cost of giving away a $12 million painting might effectively be only $2 or $3 million in real terms. For the price of a luxury apartment, they have purchased immortality in the cultural canon and erased a massive portion of their tax obligation. When we zoom out from the specific transaction to the broader economic landscape, the picture clarifies. This is not a story about art preservation. It is a story about asset management. The museum system in the United States acts as a subsidized warehouse for the private wealth of the elite.
From the digital ether, it cascades down,
The tax code is
solidifying
written
into
to
the statutes that govern us
incentivize
all.
behavior. By subsidizing the donation of appreciated assets, the government is essentially saying that the public display of a painting is worth the loss of millions of dollars in tax revenue that could have funded infrastructure, healthcare, or education. The taxpayer is effectively a silent partner in every major museum acquisition, covering the cost of the wealthy donor's tax break. This mechanism creates a circular economy of prestige. The wealthy buy art to store value. They use their influence to inflate that value. They donate the art to harvest the tax credits. The museums, hungry for inventory, validate the valuations. And the IRS, underfunded and outgunned, can only audit a fraction of these high-value returns through its art advisory panel. So, is this a loophole? Technically, no. A loophole implies an accidental omission in the law.
This is a deliberate feature. It is a subsidy for the asset holding class, codified into law under the guise of cultural enrichment. We must ask ourselves a difficult question. Who actually owns the public culture when the price of admission was paid by the public treasury in the form of lost tax revenue? Is this philanthropy, or is it simply the purchase of a tax shield with a frame around it? If you want to understand how wealth is not just made, but preserved against the erosion of taxation, you must look beyond the bank accounts and look at the walls. If you are ready to stop looking at the world like a consumer and start seeing the invisible ledgers that govern it, subscribe to the channel. We decode the game so you can understand the rules. In the end, the billionaire proves the impossible. You can keep your money by giving it away, provided you understand that in the high-stakes world of tax strategy, the frame is often more than the picture.